Hello again and welcome. We're going to have a look at market structure basics. I'm going to explain to you why market structure is so important. And we're going to identify the three type of markets, and I'm going to introduce a simple rule that is going to really help you every single day when you start your trading day. And then we're going to identify the market structure in a trending market. We're going to identify the structure in a ranging market, and I'm going to give you tips and tricks on how to approach it. So when you see a trending market, what do you do? When you see a ranging market, what do you do? I'm going to teach you how to flow with the markets and how to follow it and how to analyze it like a pro. Alright, so I'm sure you are excited. Let's just give it a start. First of all, I would like to start by explaining why is market structure so important. Well, it is the breathing pattern of the market, and it is how the market moves. It is what you're going to be seeing every single day when you open your charts. Right. So a question might pop up in your head now. What is the difference between price action and market structure? Well, what is price action? The action of the price is how the market moves. It is the candles that are printing on your screen that create the actual market structure. Alright. So actually price action creates market structure. To illustrate this even much better, I want to give you an example. I want you to imagine a painter with his blank canvas. He's about to paint a picture, and he uses his brush and colors to fill in the empty canvas and comes up with his masterpiece. He has an idea in his mind, he has an intention, and then what he uses is his brushes and colors to kind of translate that intent onto his canvas. Now I want you to imagine a blank chart when you open TradingView. Everything is blank, alright? Once you start seeing the candles starting to print, this is price action. You're going to see price action that is printing onto your chart. You're going to see the candles, and this price actually is created by all of us. We are the painters. Well, we the institutions, the banks, the hedge funds, the central banks, the big guys. We paint the market, we are the painters, but mainly the big institutions, they are the ones that control the money and the market direction. They control the price from one pricing to another, and then they're going to rebalance it. So basically they're moving the market, they're printing the price because they have all the money and they have all the brushes and all the colors in order to really influence our canvas and our chart. I really hope that little example is clear, and so that you know actually price action is printed, and you can always refer to the painter with this blank canvas. Therefore, what we can do is we have to be able to anticipate and know what the next brush stroke of the institution is going to be. That is what actually at the end is going to make you money. Because if you know where the institutions are going to go from a certain level, if you know where the market is going to move, if you know where the next move, the next brush stroke, then you are potentially going to get into the trade. This is how you're going to be making money. You need forecasting skills, but market structure makes it super easy for us to do that. The next super important thing is to be able to read row price and not rely on any indicators. That is the best skill you can ever learn. I can totally vouch for that because I started with indicators. I started with all those kinds of fancy stuff, and I'm sure you might have gone through them or are currently going through it. And I'm going to tell you, dump all your indicators. Like, yeah, if you really use them, that's fine, but you really don't need them. Why you do not need them? Because actually the price action, the market structure is building up the indicator. So you know the price action stays on top. Then we have the market structure, then we have indicators, and indicators are lagging. They are developing after market structure and after price action has developed. This is something that I want you to know. And of course, market builds a story, and big institutions are always going to leave footprints, right? They're always going to be leaving footprints where they're potentially going, where they're potentially targeting for the price to go. And if you can read between those lines and understand what market structure is doing, you will be unstoppable. Market structure lays the foundation of every strategy. If you do not understand market structure, you will have a really difficult time, because if you base your trades on indicators, it might work out, but do you really understand what's happening? Because indicators are built from price, from market structure, and from price action. They take the data from the chart and then they make it into an indicator. This is what I do not like about indicators, because if I can read row price, then I do not need indicators, because I know if a market is oversold, overbought just by looking at the charts. So the aim of this video is to lay a strong foundation of your market structure knowledge so that you're ready for more advanced strategies. A little question for you. Do you think that there is a market that moves in a straight line from point A to point B? Probably not. Does price move in sequence of highs and lows? Yes, it does. I am sure most of you know that. The market cannot go from one point to another without stopping. Does price move in sequence of highs and lows? Yes, it does. I'm sure you all know that. The market cannot go from one point to another without stopping to take a little break and to pull back, because this is the breathing pattern. You exhale, you inhale in order to exhale. So this is something that I want you to know. There is no market that is just going to go from point A to point B in a straight line. And now I'm going to answer some pretty basic questions, and I'm going to prove to you why market structure is much better than, for example, support and resistance and all those things. So the first question is, why is market structure better than classic support and resistance? And I'm going to show you in my chart. I'm going to pull my chart. Let's do something. Let's go on the 4 hourly, and let's just plot in random lines. Now that was super random. Let's zoom in and see what we can see. You can see that it resisted 3 times over here, and you can see it's got support over here, and if I move on, you can see some support over here on this line. Maybe you can see that this was support, and this was support. It went a bit down, but still. So you can see that even when I randomly plot lines, they're going to be reacting to any point, and they can be easily supports or resistance, but they don't have any actual reason as to why they are a support or a resistance. And you can see that I can even go to another chart over here. Let's plot in some extra lines. And boom, you can see this is a resistance. Somehow if I go to the left, I will find it reacting to you can see over here price kept on resisting. So for example, you go for a short over here, and you can see that price came once, came twice, and for the third time it broke resistance, and you would have been stopped out, and you wouldn't have known what was the reason, and we're always going to be lost as to what happened. This is why we're always going to be focusing on market structure. And let's get back to the presentation. Okay, the next question is, why is market creating a sequence of push and pullbacks? So have you ever thought, why do we have those higher lows and higher highs? I want to give you an example. For example, say you're going on a trip. This is where you're going to be starting from, and this is where your home is or your destination is. Say you start from here and you have to go to this place. Are you going to drive around 500 kilometers without taking any breaks? Probably not, because you're going to have to stop maybe for fuel. I have to stop for break. So basically you're going to be starting, and then you might say drive for 100 kilometers, stop over there, take a break for some food, and you start again. Say you take a break for gas, and maybe you get tired and you take another break, say to rest at the hotel, and then you maybe take one more random break, and then you finally reach your destination. I hope this example is clear. Why? Why? Because once the market moves to the upside, it just cannot continue. It has to take a break, because at every level there are going to be sellers that are going to be pushing the price, and you have to pull back. And why does this pullback occur? Because the bank wants to redistribute price. They want to rebalance price, because if you have a push, this is where they're going to be taking their profits, right? They're going to be taking the money out, and actually results in better price to the downside. So then they're going to buy again, and from here, and once the price is higher, it has to go lower again, because they're going to be taking their profits, and they'll be getting into more orders once the price gets cheaper. So this is the psychology. This is why the market moves like this. It always has to pull back, and we always create the pullback before a continuation to the upside. And if you just go into your chart, you're going to see that it's not going to be a straight line. You can see a little push, a pullback, a push, a pullback, and that's how price moves. Okay, so the next question is, when do we confirm a higher high and a lower low? So let me show you on the charts. We're going to be using wicks and body closures. So for example, this over here was a higher high, and then price moved lower, and it broke structure and closed with a body above this wick. So that means that this is a higher high, and you can see that price went lower and then came back, but did not break close with a body candle above this wick. So we can take a shot over here, and then you can see that price made a higher high, and when price closed above, that gives you a higher high. And similarly with a lower low, you can see this is the last. Once structure was broken and price closed with a body candle below this, that's a confirmed lower low. So that is how we confirm higher highs and lower lows, and this is going to help you in knowing where the price is moving towards. So that's it for this video. I hope you understood why market structure is so important. So I'm going to be wrapping it now. Please subscribe to the channel and like the video so that you could be notified when I post the next lesson. Thank you. Bye bye. Have a nice day.